Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kate, welcome to this episode of the Australian Finance Podcast.
It is good to be back on this very cold Melbourne day, Owen.
It is indeed. We are joined by someone who's probably somewhere a little bit warmer, Evan Metcalf from ETF Securities. How are you going, mate?
Yeah, not too bad, Owen. Not too bad, Kate. A little bit warmer in Sydney this morning, but still quite fresh.
Yes, you look very good in your suit. For those that aren't watching, Evan's joining us from the ETF Securities studio in Sydney. It's wonderful to see, mate. Today we're talking about bonds, and this is something that we haven't spoken about at length on the show before. In fact, over probably 3.5 years, Evan, we've only spent maybe a grand total of 20 to 25 minutes on this asset class, and yet it is something that is hugely important and talked about at length on the other side of the fence with financial advisors and institutional investors and big investment firms. So we're hoping you can give us a crash course of sorts on the bond market and basically just introduce our listeners to some of the key concepts that they might come across. Just one final thing I'll add here is we often talk about, bonds being a really important part of a diversified portfolio. Yet on the show, we've heard stories of some investors that might have 80, 90 or 100% of their portfolio just in shares or in share ETFs. So hopefully we can bring some balance to the conversation and balance to their portfolios today. Kate, I know you've got a heap of questions you want to fire off at Evan, so maybe if you go first and then I'll follow up.
Absolutely. Evan, there is a lot to unpack today, but I guess the most important question to start with is what a bond actually is and why we even need them as part of our financial system.
Yeah, sure. I guess, good to start at the high level. So a bond is essentially just debt. So it's how companies borrow. It's how companies finance their activities. So in terms of the flow of capital around the world and getting it into the right places, there's effectively two options. You can either raise equity capital, which as a business owner, that effectively means selling part of your business, and your investors on the other side are therefore effectively taking the risk that your business does well at some point in the future. The other option, which is obviously very, very common and very highly used around the world, is borrowing. So you borrow money, and most people do that via the bond market. You can do it via a bank, but bank financing is relatively limited in its appeal. So most of the big corporates, governments, semi-government type institutions, state governments, those sort of things, most of the financing and the funding for their activities is run through the bond market. So that's investors who are effectively buying these securities. They are really lending money to these institutions to effectively run their businesses.
It's hard to imagine the size of the bond market. When I was doing my research, the government has issued nearly $1 trillion in bonds, and that's not even including corporate bond market in Australia alone. It's massive.
Yeah, exactly. I mean, the total global bond market, corporate, government, the whole range is something like 120 trillion US dollars, which I think a lot of people would be surprised. It's actually bigger than the global equity market, which is somewhere probably just south, I think, at the moment, based on recent performance, south of 100 trillion. So yeah, it's absolutely massive and completely critical to the way financial markets work around the world.
Evan, would you liken the bond market to kind of like getting a mortgage versus, say, owning a home? Would that be a fair, I guess, comparison or way to think about the two different types of capital?
Yeah, that's right. That's right. So I think, if you issue bonds, you are borrowing money that you need to pay back at some point in the future. If you issue shares as a company, so that's effectively having someone buying part of your home with you. So going halves in a house with someone in particular. That's one way of thinking about it. But it's quite different. So you're borrowing money, you need to service that debt, so you need to pay interest over the life of that debt. And so that's what we think about in terms of coupons paid on bonds. and that's the income for investors in bonds. Um, Whereas, you're not actually giving up any ownership. So you have collateral. So your property is collateral for that particular debt. So as a bond issuer, you either have collateralized loans where you put up some particular assets against the bonds you're issuing, or unsecured bonds, which are just general claims against your company. So I think that's right. It's quite similar to a mortgage in that extent, but at a much more institutional level.
Yep. There are so many different types of bonds. It almost seems like people there's this steep learning curve at first. We hear on the news about governments printing money. We hear about corporate bonds, as Kate just mentioned, which might come from, say, Telstra or Commonwealth Bank or something like that. Then there are things that people might see in their brokerage account, like hybrids. Can you explain some of the, I guess, the more popular types of bonds that we might come across as investors, even if we're not investing ourselves, what we might see in our super fund, for example, or hear Warren Buffett talk about? Can you break down some of those for us?
Yeah, sure. So the bond market's really, in terms of issuers, is separated into three different categories. So you have government bonds, so things like Australian government bonds, US Treasuries, these sort of things. So that's governments looking to fund their balance sheets. You have semi-government bonds, which are slightly less creditworthy than the main federal governments, but this is things like state government bonds. Municipalities across the US are big issuers of bonds. I think in the past you would have had things like Telstra when it was a nationalized company effectively issuing bonds. They would have been semi-government bonds. And the other side is really the corporate bond market, so companies issuing bonds or commercial paper to fund their investment activities. And aside from the different issuers, you also have different types of bonds. So the majority of bonds are simple fixed rate bonds that pay a fixed coupon, so a percentage of the face value over the life of the bond, and then they pay back the face value at maturity. So if you're an issuer of a bond, you're borrowing $100, you might pay 5% per annum on that as an annual coupon, and then you have to service the debt by paying back the $100 at maturity. So that's a simple fixed rate bond. There's also floating rate bonds where the coupons over the life are linked to interest rates somehow. There's inflation linked bonds, so bonds that can provide protection against inflation by linking both the coupons and the final termination payment to inflation in a particular country. And there's a whole range of different features you can have as well. You mentioned hybrids as well. So these are bonds that can effectively be converted into shares at some point in the future. So similar to what's called convertible bonds that have different features. So that provides a little bit of protection for the companies issuing those bonds, but also adds some additional risk for investors in those bonds, in that they could potentially be exposed to the share price performance of the company at some point in the future if different types of events occur. There's a whole range of other different features, callable bonds where the issuer of the bond can call back the bonds at different times throughout the life of the bond. There's lots of different flavors, but the vast majority of those plain vanilla fixed rate bonds that you see, mainly issued by governments.
Yeah, so there sounds like quite a few there, but if we're looking at a bond ETF, or maybe looking at what our super fund's investing in, it mostly centers around those fixed rate bonds.
Yeah, that's right. They're definitely the most common, but I think hybrids in Australia are particularly popular. That's an area that's seen a lot of growth over the last 10, 15 years. There's a whole lot of different bonds, and I mentioned inflation-linked bonds as well. That was, I think, over the last 10, 15 years or so, when inflation's been a little bit off the radar and particularly low around the world by historic standards. That's been an area of the market that's been relatively neglected. But over the last 12 months, maybe 18 months or so, that's really taken off in terms of investor interest in these types of bonds. So there's definitely different types of bonds around, and different types of bonds that are useful in different scenarios. But definitely the majority is the plain fixed rate bonds.
Evan, you talked about you used a few terms in there. You said like face value. So face value is like the value of the bond. If it was $100, say, that might be paid back at maturity in the future. Then you've got a coupon payment, which sounds a bit like a dividend, which many of our listeners will be familiar with, or a distribution. There are some other things that you mentioned there, like the yield. Can you maybe just talk through that? Because this is something that we hear about it, and I think it was going back 2 years or so now, Evan, where there was this talk of an inverted yield curve, and people were up in arms. They didn't know what this meant, and it could mean a recession, and so on and so forth. So maybe if you can explain what we mean by yield when it relates to bonds.
Yeah, sure. So yield is really just the return on your investment as a bond investor. So I think unlike equities where you invest a certain amount and you wait and see what the return is and what the dividends are over the life of the investment, and where you sell when you choose to sell, that determines your overall yield or your return on your investment. With bonds, it's a little bit different because it's the end payment that's the known quantity. So if you buy $100 face value of a particular bond in, say, 10 years' time, when that bond matures, you're going to get $100. And you may also know that you're going to receive a coupon or an interest payment, effectively, of, say, $5 every year over the life of that bond. So that's known, that's fixed. What you don't know is the price that you're going to pay for that bond up front. And so the price is really what determines the yield. So it's a little, for people used to thinking about equities, it's a little kind of backwards in terms of the fact that price and yield are inversely related. So as price goes down, yield rises, right? So if you're paying less for a bond, then your return on investment is going to be more because you're receiving those same fixed cash flows compared to another investor who at a different time might have paid more for that bond. So they're going to have a lower yielding investment. So there's a little bit of different thinking there in terms of equity investing versus bond investing. But if you think about it that way, in terms of you're just paying a certain amount for known future cash flows, then it's actually quite simple.
So, Evan, we talk about diversified portfolios a lot on the podcast and how that looks across different asset classes. But as we mentioned earlier on, we haven't talked about bonds much. So, why should investors consider having bonds as part of their diversified portfolio, and maybe what role do they play as a defensive asset class?
Yeah, I think you hit the nail on the head there with the word defensive. I think that's really the key role that bonds play in a portfolio. So you have a lot of portfolios, particularly, say, younger investors that are looking for growth over the long term. They're highly equity weighted. Really, bonds can play a role in a couple of ways. So first is diversification. So bonds and equities tend to have a low level of correlation. So they give you potentially better risk-adjusted returns by having a combination of both bonds and equities in a portfolio. They're also much less volatile than equities. So you have a little bit more certainty around the returns that you're going to receive in your portfolio. So there's definitely areas of the bond market. We talk about high yield bonds that are more susceptible to things like credit risk, that are a little bit riskier. But if you're looking at a mainstream investment grade or government bond type portfolio, then you definitely have a lot less volatility and a lot more certainty around the cash flows. And it's really, I guess as investors are getting older, and depending upon what their objectives are, if they're looking to lock in portfolio value more than I guess attack growth opportunities, then larger allocations to bonds over time makes sense. And that's definitely the way portfolios, particularly skewed to retirement type portfolios, have been managed for many years.
Yeah, there's for many of our listeners that are new to investing, they probably haven't come across things like mean variance, which is I guess a strategy of where we calculate how two different things might react to each other in a portfolio, and we try and limit the amount of variability, the ups and downs, and get the maximum amount of risk for that. So it's like constructing a portfolio that, yes, you might lose a tiny bit of that growth, but what you get is more certainty when, say, interest rates fluctuate or the economy fluctuates. And as you said there, Evan, I come across a lot of investors who are approaching or even into retirement, and they're thinking, well, the most important thing isn't just year over year growth. It's actually protecting my nest egg then getting that growth as well. So that's where these bond ETFs and bond portfolios play a huge role, and we see that in super funds as well. So speaking of, Evan, like a lot of our listeners on this podcast will not have ever looked at an individual bond, or even like had an idea of like, how do I go and buy one of these individual bonds? So most of them will come across bond ETFs, like the ETFs that ETF Securities are launching, but also they might have come across unlisted bond funds where there's an active fund manager making decisions over which bonds to buy. If you were weighing up how to, even just at a very high level, how to assess a bond ETF, how to assess a bond portfolio, what are the types of metrics or factors our listeners should be looking at?
Yeah, I think maybe just firstly, in terms of how people access bonds and maybe the value that ETFs bring to that market. So there are some listed bonds that are traded on exchanges, but that's a really tiny corner of the market. So most bonds are traded in OTC or over-the-counter markets, where bond dealers will speak to each other and arrange deals, or people can buy them directly from the issuers at the time of issuance. But that's much more an institutional market. So the retail bond market is actually particularly small. So most people, for their individual portfolios, really don't have much choice when it comes to buying individual bonds. So that's where ETFs come in really handy. So they can buy the bonds at an institutional level, package them up into a portfolio, and then sell them to investors via the stock market. So they can trade them easily. They can access the bonds. They can get a managed portfolio. They don't need to be monitoring maturities and income and excess cash and these sorts of things. So there's a range of different advantages to investing through an ETF. In terms of characteristics and what you should look for in a bond ETF, I guess they come in a few different sort of flavors. I mentioned earlier around government bonds versus corporate bonds. So there's government bond ETFs for particular countries. There's government bond ETFs that are global in nature and pool a whole lot of different countries together. There are corporate bond ETFs that are at the higher end of the credit curve. So AAA type companies and the likes. So very creditworthy type companies. There's bond ETFs for companies that are in more the high yield segment, so below investment grade, which means that these companies are going to be yielding more, so that you're actually taking a little bit more credit risk by investing in these companies. So you get a little bit more in terms of the potential return, but you're taking a little bit additional risk, and there's some potential that some elements of the portfolio can default, and that's another real advantage of using ETFs as well. If you have a large spread of different issuers in your portfolio rather than just one, then that default risk as well can be diversified away. And aside from that, there's a whole lot of different other characteristics. So different maturities is one big one. So you may have a particular view. You talked about yield curves and things before. So yield curve is really the interest rates available for different terms of investment. So you may have views on 2-year interest rates or 10-year interest rates. Different types of ETFs will have different tenors or durations, which is really the bond term for how people measure how long dated a particular bond is, or what its exposure point is on the yield curve. And yeah, I mean, other features, we talked about index-linked bonds as well. There's index or inflation-linked bond ETFs that people can invest in. So yeah, there's a lot of different characteristics. In Australia at the moment, there's a collection of domestic bond ETFs. There's also global bond ETFs. All of the global bond ETFs are currency hedged. So I think when you're looking at bond ETFs and just fixed income investing in general, you really don't want to be taking that additional currency risk as well. So there's not a lot of point to investing in, say, US dollar treasuries when you're taking a lot of risk around the Aussie US exchange rate. So most bond ETFs are currency hedged as well, which is an important thing to consider.
Yeah, Evan, I was going to mention that because the two bond ETFs that you've launched, the Treasury and High Yield, are both currency hedged, and people probably are wondering why. And just to add some context to that, so obviously when you invest overseas and you're investing in a fixed income asset, if you have a currency like the Australian dollar bouncing up and down in between, you kind of lose the benefit of having that yield or that defensibility overseas. So ETF providers and if like counterparties will hedge out or neutralize that currency risk there. Another thing you mentioned there, just if I could just summarize, was the investment grade, or how high a quality the bond is and where it sits in the capital, what we call capital stack. So so things like that are AAA rated might be government bonds, and they're typically the most secure and higher yield, or sub investment grade, or below investment grade may have like a BBB rating. So we go down that rating. And the idea, Evan, if I'm not mistaken, is that the kind of the lower the investment grade or rating, the higher the yield. So you get potentially a higher return, but you potentially face higher risks when you invest in something like that.
Yeah, that's right. So when you're pricing a bond, you're looking at not just the prevailing level of interest rates, but also the amount of credit risk that you're taking with a particular issue. So it's fixed income in that you know what the cash flows are in the future, but if there's a chance that the issuer could default, then those cash flows all of a sudden become a little less certain, and you need to the issuer needs to effectively give you a premium to take their debt versus taking the debt of a highly secure government. So there needs to be some incentive to invest in companies that are, as you say, triple B or lower, and that incentive comes through the additional yield that you can receive.
We also talk a lot about having a core and satellite portfolio when we're investing. And I guess the interesting thing to explore is how do bonds fit in that? We talked about using them as part of our diversified portfolio before, but would you see bonds as a core part of someone's portfolio, or more of the satellite around the edges?
Generally, bonds are very much a core part of the portfolio, particularly if you're looking at mainstream government bonds, corporate bonds. I think if you get to areas like high yield bonds, emerging market bonds, and those sort of slightly riskier plays, then they could be seen as a satellite, or maybe in addition to a core portfolio. But yeah, generally, when people are investing and constructing portfolios, they look at it along the lines of asset class breakdowns, and fixed income is one of the major asset classes across global capital markets. So that's very much a core holding. But there's obviously choices as to how you construct the bond portfolio within that.
Mm. Evan, you mentioned before that ETFs make the process of accessing the bond market easier because you, as an ETF provider, can effectively access, as an institution, some of the things that us as retail investors or smaller investors simply cannot. For example, some of the bonds that you may be buying in millions of dollars, we can't access them as individuals, nor would we want to, because then it would all of a sudden become more than 100% of our portfolio is tied up in bonds. So can you maybe talk to, I guess, the benefits of using ETFs? We know you've got two that have launched recently or are launching now. Can you talk to the benefits of using an ETF? Just to highlight that, because I think a lot of our listeners are focused on ETF investing. So any type of color, or I don't know, risks or benefits or what have you on ETF specifically for the bond market would be great.
Yeah, so an ETF is going to be tracking a benchmark index generally, unless it's an active ETF. And benchmarking in the bond market is a bit different from the equity market. So in the equity market, you have a company, it has shares, and those shares are listed, and each company has one share. In the bond market, it's very different. You may have a major corporation, may have hundreds of different bonds outstanding at any one time. So in terms of the actual number of potential securities involved in a bond kind of benchmark index, it's a lot bigger than an equity index covering equivalent markets. So you may have a benchmark bond index with 5,000 bonds in it, for example, which is you think about the MSCI World or one of those broad equity indices that might have somewhere in the range of 1,000. So they're very big in terms of number of constituents. So even for an ETF, buying all of those bonds is effectively not possible and impractical. Some of them are illiquid if there's smaller issues. Some of them are extremely small weight, so it doesn't make sense to buy them to replicate the index. So most bond ETFs actually use a sampling method where they don't buy every bond in the index. They buy a collection of bonds that they feel is representative of the particular index. So even at the ETF level and the institutional access level, it's not always possible to buy every single bond. So think about it from a retail investor's point of view. It's nearly, well, it is completely impossible and impractical, and the way that retail investors access the market as well isn't the scale. You can't buy small portions of some of these bonds. So ETFs really have a big role to play in packaging these portfolios together and giving people easy access to the bond market that way.
Mm. Yeah, and I think this is a kind of a really neat way for investors to access that defensive part of their portfolio, because traditionally you would have to use an unlisted managed fund if you wanted that diversification. So you have to fill out the forms and you have to go through all of that. And so maybe just here on the end, Evan, you can just talk a little bit about the two new funds from ETF Securities. One focused on high yield, one focused on treasuries. One of the questions that I had around this was kind of like why now as a time to launch this? Is there something that you as a firm see in the market, or is this something that's just missing for investors to choose from on the ASX, or in the ETF portfolio generally speaking?
Yeah, so we're launching two funds that are really at either end of the credit spectrum. So we've got the super safe US Treasury product and the slightly more exotic high yield product, which is looking at those companies rated triple B and below, or below triple B, sorry. So really both ends of the credit curve, people can choose what they like in terms of security versus yield. There's quite a difference between those products in terms of yields on offer. Timing wise, I think it's actually an interesting time for bonds. So yields through the last few years, even coming out of the financial crisis, sort of 15 or so years ago now, yields have been very low for a very long time. So that's been pushing bond prices higher and higher, to the extent that many people's view was that they couldn't go much higher. So what's happened recently? We've had central banks pulling back from these stimulus measures, starting to raise interest rates. So at the moment, we're looking at projected interest rate rises of 2% plus over the next 12 months or so in both Australia and in the US, and that's actually creating some potential upside for bonds. So if the market's pricing in these very steep interest rate rises over the next year or so, there's potential that the market has got ahead of itself to some extent. So a little bit of good news on inflation, a little bit of better news in terms of growth in some of these areas. Those expectations could pull back, which does actually create some upside for bonds. So I think for once there's really a two-way market in terms of, for the first time in a while, there's a two-way market in terms of which way bond prices and yields can go. So there's definitely some opportunities there. And historically, we've also seen that in terms of expectations of future rate rises getting ahead of the market and then having to pull back at some point. So there's some upside on the treasuries. We also see that as an interesting area, given all of the global bond ETFs in Australia at the moment are broad in terms of offering exposure to everything except Australia. So we think targeting US being the largest bond market in the world is an interesting play as well. So providing something a little bit different for investors, avoiding some of those really low yielding bonds coming out of Japan and Europe, where you've had negative yields over the last 4 or 5 years. So we think that's an interesting opportunity.
Mm. Yeah, it's so this conversation, Evan, we try to make it I guess simple for people to understand, because it is so important, yet it's often a point of their portfolios that are neglected. Warren Buffett, is one of the things that he famously said was that if he was to just choose to a simple asset allocation, he might do 90% in equity index funds and 10% in short-term government bonds. So that's kind of like, it's, I guess, his general rule of thumb. But then others are saying, the academic approach is 60-40 for a balanced portfolio. So it gives our listeners a sense of how that part of their portfolio comes together. And obviously a financial advisor would sit down with you and go through this on a case-by-case basis. But Evan, you've done a fantastic job of introducing us to the idea that this is a really important part of the portfolio. There are many different ways to access the bond market, but ETFs make that simple in the sense of capturing that the exposure to the market that would otherwise be really hard to get. You can do that on exchange just through a brokerage account. And if we're investing globally, I think one of the takeaways from this episode should be try and find currency hedged ETFs or bond ETFs, because they neutralize that currency impact. And then you also broke down the jargon for us, which is fantastic. So things like duration, which you mentioned, maturity, coupons, and yield, which is something that all of our listeners will come across if they're investing in bond ETFs. So we'll include more links in the show notes to the two new funds, as well as some of the jargon busters on the bond side of the equation. So Evan, I think you've done a fantastic job of explaining what is often a very complex part of our portfolios. And for the first time in 3.5 years, we've covered bonds. So thank you for joining Kate and I on the show.
Fantastic. Thanks, Owen. Thanks, Kate. Pleasure.